All right, everyone, let's dive into one of the most fundamental and, frankly, one of the most elegant concepts in all of Canadian tax: integration. It answers a really simple question. Is it better to earn a dollar yourself or through your company? The answer is, well, it's complicated, but the goal is for it to be the same. Understanding this is the key to unlocking the entire world of corporate tax. Just a quick note before we get started. All the materials for this explainer were prepared by Dr. Samir Al-Rashani, with some AI support to help us model these complex examples and really bring the numbers to life for you. So, here's our roadmap for today. We're going to start with the why, the big goal behind the whole system. Then we'll get into the how, the specific tools the CRA uses. After that, we'll walk through a concrete example to see it all in action. And finally, we'll circle back to see if this whole complicated system actually works. This is the question. This is the whole ballgame right here. Your gut instinct probably tells you there has to be a tax advantage one way or the other, right? But the entire Canadian corporate tax system is designed from the ground up to make the answer to this question, it's pretty much a wash. Let's see how they actually pull that off. So let's start with the big picture. Before we even touch a number or a rule, you have to understand the philosophy. Because once you get what the system is trying to do, all the weird, complicated rules suddenly start to make a whole lot more sense. And that big idea is called tax neutrality. The government really doesn't want the tax code to be the reason you decide to incorporate a business. So they've built this system where the total tax paid, that's the tax the company pays, plus the tax you pay personally when you take the money out, should be almost identical to the tax you would have paid if you just earned that money directly in your own name. Okay, so if the goal is neutrality, how does the system make it happen? Well, it has to be pretty clever, because not all income a corporation earns is the same. The very first step in the whole process is for the system to figure out what kind of income it's looking at. And this, right here, is the most critical distinction you need to understand: active versus passive. Active business income, or ABI, is pretty straightforward. It's money from being active, making things, selling stuff, providing services. This is seen as the engine of the economy, so it gets a nice low corporate tax rate. But passive income, that's different. That's money your money makes, things like interest, rent, or investments. And oh boy, the system treats this very, very differently. So why the tough treatment for passive income? What's the deal? It's all about plugging a massive potential loophole. See, if passive income also got that low corporate tax rate, what would you do? You'd stick all your personal investments inside your company and just leave them there, deferring tax for years, maybe decades. So the government puts a really high tax rate on it specifically to stop you from using your corporation like a personal piggy bank. And when I say high, I mean wow. In Ontario, for example, the combined rate is a jaw-dropping 50.17%. That's even higher than the highest personal tax rate. Now, when you first see that number, you're probably thinking, wait a minute, Professor, that completely shatters the whole idea of neutrality. And you're right, it seems that way. But this is only part one of the story. So how does the system take that absolutely punishing 50% tax rate and magically bring it back into balance with everything else? It does it with a very specific set of tools. Let's call it the integration toolkit. And the most important tool in that kit is something called the Refundable Dividend Tax on Hand, or RDTOH. Think of it like this. When the corporation pays that huge 50% tax, a big chunk of it isn't actually gone for good. It's more like a deposit. The government holds on to it, and it promises to give that money back to the corporation. But there's a catch. You only get it back when you pay the profits out to the shareholder. The system is incredibly precise about this. Of that 50.17% tax the company paid, exactly 30.67 percentage points of it gets funneled into the special notional RDTOH account, just sitting there waiting to be refunded. The next tool is the General Rate Income Pool, or GRIP. This is another one of these running total accounts that the company has to keep track of. But its job is different. Its job is to keep a tally of all the business income that was taxed at the high general corporate rate, not the low small business rate. Think of it as a way for the company to send a signal to the tax system. And here's what that signal is all about. When a company pays a dividend out of its GRIP balance, it's called an eligible dividend. That's the company yelling to the CRA, hey, we already paid a lot of corporate tax on this money. And the CRA says, okay, we hear you. And it gives the shareholder a bigger tax credit, which means they pay less personal tax. On the flip side, if the income was taxed at that low small business rate, it's paid out as a non-eligible dividend, which comes with a smaller tax credit and, you guessed it, higher personal tax. It's all about balancing the scales. Okay, enough theory. The absolute best way to see if this actually works is to just follow the money. So we're going to take $100 and trace its journey from the company's hands all the way to the shareholder's pocket. This is where all those tools and concepts we just talked about finally come together. So first step, what happens inside the company? If the company earns $100 of general business income, it pays 26.5% in tax, leaving $73.50 to pay out. If it's small business income, the tax is much lower, only 12.2%, so there's $87.80 left. But look at the investment income line. This is so cool. The company pays that huge 50.17% tax up front, but because it's paying out the dividend, it instantly gets that 30.67% RDTOH refund. So the net tax inside the company is only 19.5%, leaving $80.50 in cash. See how different the cash amounts are that are about to go to the shareholder? Now, before we calculate the personal tax bill, there's one last piece of magic we need to understand: the gross-up and dividend tax credit. When you get a dividend, the government first grosses it up, meaning they add a phantom amount back on to guess what the income was before the company paid tax. You calculate your personal tax on that bigger number, and then you get a tax credit to compensate you for the tax the company already paid. It's a bit convoluted, but it's the mechanism that links the two tax systems together. Okay, here it is, the shareholder's side of the story. The $73.50 dividend from the general rate income is eligible, so it triggers about $29 of personal tax. The shareholder is left with $44.58. Now look at the small business path. The shareholder gets a much bigger check, almost $88. But because it's a non-eligible dividend, look at the personal tax. It's almost $42. And what's the final after-tax amount? $45.88. Incredibly close to the first one. You can actually see the system balancing itself out in real time. So we've seen the corporate tax, we've seen the personal tax. Now it's time for the moment of truth. Let's add it all up, put it side by side, and answer that big question we started with. Did it actually work? And there you have it. Just look at how close those bars are. It's pretty amazing. If you were in the $100 personally at the top tax rate, you'd pay 53.53% in tax. If it flowed through your small business, the combined corporate and personal tax is 54.12%. Through a large corporation, 55.42%. The differences are tiny, just a percentage point or two. This is tax integration in action. It actually works. Now, I've been careful to say integration is approximate, not perfect. This table breaks it down precisely. For active business income, in our example, there's a very small tax cost to using a corporation. But what's really interesting is that for investment income, there can actually be a small tax saving. These numbers will shift around based on province and tax bracket, but the main principle of neutrality absolutely holds true. Okay, that was a pretty deep dive into the numbers. So let's pull back up and summarize. What are the absolute must-know key takeaways from all of this? Let's lock them in. First, the goal is neutrality. The system doesn't want to pick winners. Second, income type is everything. Active versus passive drives the whole calculation. Third, RDTH is the magic key that makes integration work for investment income. Fourth, dividends are not just cash, they're signals that communicate tax history. Fifth, the system is approximate, not perfect. And finally, and this is huge, even if the final tax is the same, corporations offer one massive advantage: the power of tax deferral. You can leave the after-tax profits in the company to grow, and that is an incredibly powerful tool. And that really leads us to the final strategic question I want to leave you with. If integration works so well that the actual tax savings are pretty minimal, does that mean the single biggest advantage of using a corporation isn't about saving tax at all, but about delaying it? Thinking through the answer to that question is what separates a bookkeeper from a true tax planner. Thanks for tuning in today, everyone.